Ashwani, Mathur here. I hope you can see a slide which says welcome to TradingHD. So welcome to TradingHD. And I'm going to have to take you through a disclaimer first before we can start the presentation. And I'm going to read it out, which says, the information contained within this presentation is intended for educational and illustrative purposes only and does not constitute investment advice. Do not make any investment decisions or other decisions based on the material presented. We cannot be held responsible for your trading results. For more information, please visit www.tradinghd.com. So here we are. My name is Ashwani Mathur. Thanks, friends, for being on the webinar. As you can see, there's a little bit about me written here. I've been in the industry for over 2 decades now, most of the time being a stockbroker, having serviced some major hedge funds and long-only investors since the early 1990s. I've dealt in pretty much every equity market globally over the last 20 years. Started out as a fundamental analyst for the first few years, and then started to cover charts and look at price action. And here are my 2 or 3 basic points that I'd like to make up front, which is that the key to success in markets, in my view, is to simplify markets as much as you can. And charts are something that help you do that objectively. But let me tell you something, that charts are not really the holy grail. You must understand what you are trading at all times, and you must understand the fundamentals behind the businesses that you buy and sell, and you must know why you are trading something. Charts will help you confirm or question your thesis. That said, there's a little quote about me by Lex, who is a partner in the education business along with me in our education journey, trying to share our experiences with all people globally. So there's something nice that Lex has said, which is very welcome. Thank you for saying that, Lex. So I think we should dive straight into what I think is of paramount importance and interest for everybody who is on the webinar today, which is, how do you actually analyze a price chart that you see? So I'm showing you here a long-term chart of the S&P, which is the Standard & Poor's 500 index of the 500 largest market cap stocks in the US. And I'm showing you a monthly closing price chart going back from 1995 to 2015, which is up to now. And what I want to show you and share with you today is something I wished I was taught when I was starting out in the business myself. I've been through every technical indicator that there is out there, from Fibonacci to Gann to Elliott waves to MACDs, and I've been through this for the last 20 years. And what I've found is that sometimes the easiest things to follow in the markets are the simplest things. And that's what I'm going to share with you today. So there are 4 things to bear in mind through the course of this presentation. All charts are in US dollars. All prices are closing prices in black based on the time frame that you're looking at, whether it's a daily, monthly, or a weekly chart. The red line, which is going to be consistent throughout the presentation, is the 45-period exponential moving average. The blue line is the 200-period simple moving average. And the bottom panel is the 14-period RSI, which has horizontal bands of overbought and oversold between 60 and 40, as you can see on my cursor. I hope you can see the cursor working here. Now, I use the RSI very differently to what is conventionally taught in the marketplace, where 70 is overbought and 30 is oversold. In my instance, you will see that I've used 60 and 40 as my RSI bands. Here's the closing price chart. There's the 45 EMA, there's the 200, and this is the movement of price over the last 20 years. To give you a very simple golfing analogy here, if you had to play a round of golf with just one club, what club would you choose? Well, being a golfer myself, I would choose a 7-iron. So if I have to trade markets using just one indicator, the indicator that I would use would be an RSI. So let's see how to use this RSI, because once we are able to understand how the RSI is used along with price and the moving averages, all the slides further down will become very easy to understand. So let's start with the movement going back to the 90s. My contention is that when the RSI gets above a reading of 60 on a monthly price chart, that is an indication of a market that is in a strong bull trend. And a strong bull trend does not finish till the RSI actually breaks 60. So when you're above 60, you remain overbought for 5 years, as you can see, and the market has a tremendous run. But when you break 60 for the first time, that is when you start a potential downtrend. You can see this circled here. After that, when the downtrend is over, it becomes safe to buy the market again once 40 has been recovered. But that's not it itself. You also need to see the movement of price along the 45 EMA. And if the 45 EMA has been broken, it's one of my golden rules. If you actually looked at my course that is on TradingHD's website, you will see that one of the guidelines that I follow as a trader is never to be long a market that is trading beneath its 45 period exponential moving average. As you can see, if I had applied this, I would have been able to stay out of the market for 3 years, which was a terrific time to be out of the market. Then again, once the 45 is recovered, you're potentially in a bull market again. You have higher highs and higher lows in place. And that is another very simple definition of understanding markets. Now, when you're making lower tops and lower lows, you're in a downtrend. When you're making higher highs and higher lows, you're in an uptrend. But an uptrend itself is not enough. You must regain the moving averages. But more importantly, once you take out the once you take out the 60 reading on the RSI, you create the basic essence of a bull market. Then you can see from 2004, 2005, the 60 reading on the RSI was never broken for the next 3 years. This was a fantastic time to be long the market. And then you see again in 2007, the bear market only began once the reading of 60 was broken. And once you were beneath the 45 period exponential moving average, not until 2009, 2010, which is when it was recovered, was it safe to go back in the market again. So again, very simple tools, but gives you a very good broad picture of what the market looks like. Let's apply this to the current market and see what happened between 2011 and 2015. From 2011 is when the 45 EMA was recovered. Throughout this period, we made higher highs and higher lows, higher highs and higher lows. And at no point was this trend in danger of reversing because the RSI was consistently above 60. That is the definition of a bull market. Now we have broken 60 on the monthly RSI for the first time in 4 years, which tells you that something could be happening here. But notice that the 45 EMA has not broken. The price is still above the 45 EMA, but we are in a crucial testing phase here. For this bull market to exceed and get onto new highs, the RSI needs to close above this 60 reading and not fail like it failed in 2000 and like it failed in 2007, 2008 beneath 60. So to understand this a little bit better, let's move on to a slightly lower time frame chart, which is the weekly time frame. Again, if you apply this very simply between 2012 to 2015, you will see that at no point was the 45 period. I mean, how beautiful is this? Simple tool. You don't have to listen to experts. You can just do your own work and see that you're in a very strong bull market trend. Higher highs, higher lows. But notice what started to happen in first quarter of 2015. The RSI on a weekly time scale started to consistently fail at 60. Do you see that? You see these arrows here. You see how the RSI is unable to penetrate the 60 level. That is the sign of a market that is beginning to start to lose momentum. And when you start to lose momentum and you've crossed beneath the 45 EMA and you have an RSI beneath 60, you open yourself up to dramatic declines, which is exactly what has happened in August and September. But this was not a surprise, friends. As you can see, when you start failing at 60 on the RSI, those are very good warning signs that the market is about to lose momentum. Let's look at the same slide now on a daily time frame to see whether we could have actually seen this in real time as the markets were evolving. And now notice the behavior of the RSI. This is the same 14-period RSI, same 60-40, and see the multiple times between April, May, June, and July that it just could not